So what does it actually take to transform a massive, money-losing EV maker into a highly valued AI and software powerhouse? Today, in this explainer, we're unpacking a 20-step financial chain reaction that could completely reinvent Rivian. Look, this isn't just about selling more trucks. It is about a fundamental shift in how a company is valued. We're going to trace the exact sequence of events. Think of it like a giant domino chain that analysts have mapped out to push Rivian's valuation all the way to a $60 stock price. Now, you're probably asking the same ultimate question every investor is asking right now. When does the narrative actually change? When does the market stop treating Rivian like a speculative startup and start valuing it as a scaled, profitable enterprise? What we're looking for here is a valuation re-rating. That's essentially Wall Street tearing up their old rulebook and pricing the company in a completely new, vastly more valuable way. And based on the data, this shift isn't years and years away. It could trigger as early as late 2026 through 2027. But for that window to open, a very specific sequence of events has to play out flawlessly. Here is the craziest part of this whole 20-step roadmap. The very first domino, it's actually already fallen. In their Q2 2026 results, Rivian delivered a massive $1.658 billion in revenue. That's up 27% year over year. And even more crucially, they generated a $179 million gross profit, with vehicle deliveries actually beating market expectations. So they've laid the groundwork, right? They've proven they can bring in serious cash. But to get that massive re-rating, they've got to scale it. To make sense of all this, we've broken this complex roadmap down into 4 phases. Phase 1 is the R2 foundation. Phase 2 is the profitability pivot. Phase 3 is the autonomy multiplier. And finally, Phase 4 is the path to 60. All right, let's kick things off with Phase 1, the R2 foundation. This execution window, it's incredibly tight. We're basically looking at a sprint here. Between August and October 2026, we hit the evidence phase. Rivian absolutely has to prove that customer demand for their new R2 vehicle is off the charts. Then, November brings Q3 earnings. That is their first major re-rating opportunity. Right on the heels of that, in late 2026, they have to deploy capable, working point-to-point autonomy software. Hit all those marks, and 2027 becomes the golden window where consecutive quarters of volume growth and shrinking losses finalize that true re-rating. It really comes down to a strict mechanical progression. Step 1, R2 deliveries have to begin with immense customer demand, pushing Rivian way beyond their expensive R1 niche. Step 2, production has to ramp up way faster than anyone expects. And Step 3, revenue accelerates. When these 3 steps happen in order, it forces a massive narrative shift. Investors stop seeing a niche manufacturer, and suddenly they're looking at a high-growth company again. But growth just isn't enough on its own. It has to be profitable growth. If Rivian can nail 4 specific targets in their November 2026 earnings, meaning higher revenue, improving margins, lower costs, and reduced cash burn, the entire conversation flips. Wall Street will stop asking, can Rivian survive? And they'll aggressively pivot to demanding, okay, exactly how profitable can this company become?
Which brings us perfectly into Phase 2, the profitability pivot.
This right here is the major psychological turning point. The old Wall Street thesis viewed Rivian as a cash-burning machine facing endless financing risks. Because let's be real, bending metal and building physical cars is a brutal business. But post-pivot, a brand new thesis takes over. Institutional financing risk drops off a cliff, and long-term earnings expectations absolutely soar. They get recognized as a scaled platform with proprietary software, custom AI silicon, and most importantly, recurring revenue.
Now, let's step on the gas. Phase 3, the autonomy multiplier.
Rivian is building a brilliant data flywheel here. Think of it like a giant self-feeding loop. More R2 vehicles on the road equals a massive pipeline of real-world driving data. That immense pipeline feeds directly into better end-to-end large driving models, which drastically improves their point-to-point autonomy plus capabilities. And what happens when the software gets undeniably good? More customers eagerly subscribe to it. This takes them from a basic eyes-on system to eventual eyes-off driving. Under the hood, these late 2026 R2 vehicles are going to introduce the Gen 3 architecture. We are talking custom silicon, advanced cameras, radar, LiDAR, and a massive 1,600 TOPS that stands for trillions of operations per second of pure AI computing power. Deploying this gives investors hard physical evidence of their tech leadership. I mean, it's a system explicitly designed to ultimately reach level 4 autonomy, where the car handles the driving completely on its own. So why does Wall Street care so much about all this hardware? Because of this exact number, $49.99 a month. That's the recurring price for their Autonomy Plus software, or you can pay a $2,500 one-time fee. Software margins are just astronomically high compared to manufacturing cars. Multiplying that monthly subscription fee by a massive fleet of vehicles creates a highly lucrative second economic engine that totally transforms our gross margins. When you combine that cutting-edge hardware with recurring software cash flow, a total identity shift happens. Wall Street stops valuing them as just a car manufacturer. Once they actually see point-to-point autonomy working in the real world, like a driver punching in a destination and the Rivian seamlessly taking them there, the perception upgrades. They go from an EV manufacturer to an EV, AI, and autonomy company. They're suddenly valued as a physical AI platform. Okay, let's bring it all home with Phase 4, the path to 60. This breakout happens in very distinct stages. First, the stock hits the $30 anchor. This is the foundation. It triggers when the market formally accepts that R2 execution is the real deal. Strong customer demand is verified, production is scaling without any massive hiccups, and overall gross margins are tangibly, visibly improving. Then, things accelerate to $40. This happens once profitability isn't just a promise anymore, it's undeniable. Forward guidance gets stronger, subscription rates climb, and the financial community is basically forced to aggressively upgrade their price targets because the long-term earnings potential is officially de-risked. And finally, we hit the $60 target. This is where momentum and FOMO, the fear of missing out, just explode. Short sellers are forced to cover their positions, massive growth funds start gobbling up shares, and retail momentum skyrockets. The market begins aggressively pricing in substantial 2027 and 2028 software success well ahead of time, potentially even pricing in future autonomous fleets or robotaxis.
This quote pretty much nails the whole shebang. R2 gets Rivian toward 30 to 40. Profitability validates the business. Autonomy gives investors a reason to pay 50 to 60 plus. It's vital to understand this hierarchy. Flashy Autonomy Day presentations won't trigger a re-rating on their own. Selling physical R2 vehicles is the absolute necessary foundation. But that recurring software revenue, that data flywheel, that is the ultimate valuation multiplier.
So I'll leave you with this final thought to chew on. Can Rivian actually pull off this incredibly aggressive bull case and hit all these milestones at lightning speed before the end of 2026? It requires absolutely flawless execution across production, demand, hardware, and bleeding-edge AI software, all in a very tight window. Are you betting on all these dominoes falling perfectly, or do you think the market makes them wait until 2027 to prove it?